Refinance math can get a little complicated. It's a little intimidating. There's a lot of numbers floating around. Many loan officers don't realize the difference between what they know from doing the job and what you know from not doing a mortgage industry job. So my whole goal in this video is to walk you through the key numbers and components of a refinance to arm you with the information that you're going to need to make a confident, fully informed decision when you're looking at your own potential refinance. Where we're going to start, I've put together this very basic spreadsheet. It doesn't look all that good, but it contains the key numbers that I want to talk about. We're going to start in this section over here, loan structure and payment. Now, by the way, the kind of compliance department caveat that I have to give you is that none of the numbers on this have anything to do with a quote. These are totally meant for illustrative purposes. They're not meant to indicate what mortgage rates Guild Mortgage is offering, the terms that we're offering. These are all just to explain the concepts. So in this loan structure and payment, the first number here is arguably one of the most important numbers involved, and it's your appraised value. Your appraised value actually determines the outcome of your refinance in a couple different ways. The tricky part is we don't know what the appraised value is on day one of an application. Now, there are some people, some lucky people, and there's more and more of these people over time. There's some lucky folks that are benefiting from what's called an appraisal waiver. The short version on that is that when the loan officer enters their property address into something called an automated underwriting system, if we're talking a conventional loan that is not a jumbo, so jumbo limits depend on where you are, but if you're into the $800,000 range, you might be in jumbo territory. If you're a non-jumbo loan, and if the mortgage agencies have enough data that they've collected to support the value as entered on the automated underwriting system, they may just give you a thumbs up and say, yeah, that value seems about right. We don't need an appraisal. But for everyone else, we have to kind of start with the number. On my clients, I tend to be very conservative with all of my assumptions. Any number that's not under my direct control, we're going to be conservative. And what we'll often do is come up with, maybe talk to a realtor or somebody else that knows the property, that knows market values. Let's come up with a conservative estimate of value. Let's take a look at some options based on that conservative assumption of value. And generally speaking, if the appraised value comes in higher than what we've estimated, it's likely that the terms might get a little bit better. So we're going to start in this instance with a projected appraised value of $600,000. Next up, existing loan payoff. So you've got an existing loan you're looking to refinance. The payoff, it is very much worth pointing out that the principal balance you see on your statement or on the website for your mortgage, let's call that in this case, maybe the actual principal balance is $498,000. The payoff is always going to be higher than that principal balance because it has to account for the days of interest that are going to remain unpaid via a traditional monthly mortgage payment. It's worth noting that a mortgage payment, when due on the 1st, is paying for all the accrued interest of the prior month. So if we're closing your refinance, let's say, in the middle of November, the loan payoff is going to have to account for all of the interest from November the 1st through, let's say November 15 is when we get them paid off. So the payoff is going to be the principal balance plus those 15 days of interest. Therefore, it's always going to be higher than that balance. So we're going to keep the numbers round here. Existing loan payoff at $500,000. Next, the new loan amount. I've set that at $500,000. In this case, this borrower, the aim here is to take out a new loan only to cover the payoff on the existing loan. Now, we can have some fun with this, depending on the appraised value. As long as your loan amount does not exceed a certain threshold that may impact your interest rate. In this case, if the loan amount went above a certain amount, there might be private mortgage insurance involved. If you've got less than 20% equity in the home, you're typically going to have to pay PMI. So within, let's say, guardrails, you're free as the consumer to move that loan amount up or down to achieve whatever kind of net funds due at closing picture you want. Just to kind of play around with this loan amount is currently set at $500,000. If we were to adjust it, and actually if you just to move ahead here, down at the bottom left here, you're going to see the total cash due at closing. If we have the loan amount set at $500,000, the amount due at closing is going to be about $9,000. So let's just play around with this. Let's say 509 is the loan amount that we want to take out. That adjusts the payment up, but it comes with a nice benefit here of seriously reducing the amount due at closing. So again, this is a variable that you can move up or down to achieve whatever net outcome you're looking for at the closing table. I'm going to move that back to 500. All right, the interest rate, again, totally made up interest rate just to illustrate the concept. We're going to call it 6.125. Maybe this fellow right now is sitting at 7.25, 7.375. So he is in line to refinance. We see the principal and interest payment breakdown here. I have gone ahead and entered an amount for property taxes, for homeowners insurance. The assumption here is that this borrower is choosing to escrow for taxes and insurance. Side note, if you have more than 20% equity in the property, you can, in most cases, choose to waive escrows. Many times that's going to come with maybe a small fee or a slight hit to the interest rate. But by waiving escrows, you can actually seriously minimize the complexity of a refinance, as we're going to get to. But to illustrate that, we're going to assume an escrow in this case. We add up everything that's a component of the payment. We end up with $36.38. When this client is evaluating this option, it's certainly useful to know what you're paying right now. You can determine the monthly savings. As I mentioned in my last video on kind of getting the timing right for your refinance, the old rules of thumb are totally garbage and pointless. You do not need to save a full percentage point or more for you to benefit on a refinance. It really just boils down to cost versus benefit. So in this case, on the benefit side of the equation, well, we've got $234 a month saved. That is only one aspect of the savings. You can get into a lot more detail if you dive into, okay, total interest spent over time, etc. But I think it's kind of a useful thing to know is just the monthly payment savings. And if the cost is worth the $234 a month, then you've got your answer as to whether or not it makes sense to refi. Speaking of costs, costs are divided on a refinance into two categories in my mind. I think it is very useful to separate closing costs from your escrow deposit and any prorated interest that's going to be due at closing. The closing costs are the fees that are actually triggered by you doing the refinance. When you're looking at your cost versus benefit, I think it's very important to isolate down to the actual transaction charges, the actual closing costs, because the escrow stuff, the typically massive amount of money that you're going to need to deposit to set up the new escrow account, that should not be thought of as a cost associated with doing the refinance. Reason being, although we have to play this kind of silly shell game where we have to deposit new money into the new loan for the new escrow account, when we do that and we pay off the old loan, you're going to get a refund for any funds left over in your existing escrow account. This does not represent an actual cost of the refinance. It is money that we have to plan around and deal with as it relates to the amount that's going to be due at the closing table. But when evaluating the strength of a particular refinance proposal, I think it's very important to isolate down to closing costs. Now, your lender's closing costs may look different than what you're going to see here. In fact, my official quotes, my official loan estimates, the line items do look a little bit different. This is, again, just to illustrate the concepts. You've got what I call red letter fees and black letter fees. The red letter fees are the actual fees paid to the lender. These are fees that lender controls and dictates. The black letter fees, these are for the various third-party services that the lender undoubtedly is in the driver's seat of determining the vendors for these services, but they're not basically governed by the lender. These are third-party fees. So in this case, what you want to look out for, total lender fees. Lender fees are going to go by a million different names: origination fee, processing fee, underwriting fee, admin fee, tax service fee. Although that kind of sounds like a third-party cost, that is a lender closing cost. Whatever they're called, I recommend just adding it all up and figuring out what are your total lender fees associated with this refinance. Now, in this case, at this interest rate of 6.125, this program is coming with a lender credit. Now, what we know going in is that if there's a lender credit available at 6.125, this borrower could get a lower interest rate and maybe not get any lender credit at all. When you play on a refinance up and down the rate sheet, as you move up in rate, you move down in closing costs because there will be more and more lender credits available as you move up the rate sheet. Conversely, as you go down the rate sheet, you're going to have points. You can pay additional closing costs. Get no lender credit, pay additional closing costs to reduce that rate. But I wanted to show the lender credit in this case because, in my personal opinion, I think the vast majority of people should do a refinance with some sort of lender credit built in. I just think it's important to protect you from paying too much in the way of closing costs, especially because the situation that we're in right now in the market, I think a lot of people are going to be riding the escalator down. We're going to do a refinance based on the drops that we've seen so far. We're going to have those loans hang out for 6 to 8 months or so. If in that time interest rates fall further, it may make sense for that person to do an additional refinance. So I'm a pretty big advocate in this environment for structuring your refinance with lender credits involved. In this instance, the lender credit of $1,875 is more than sufficient to cover the $1,795 in lender fees, with a little bit extra towards some of these third-party charges. Next, we go into the escrow. We already kind of talked about that. There's a deposit that you need to make to set up the new escrow account that is offset by a refund from the old escrow account. One thing that I did not actually write down on here is, depending on the day of the month that you close on the new loan, there's going to be interest due from that date until the end of the month that you close in. That is simply going to be a matter of timing. However, one thing you can know going into this, assuming you're doing the refinance to lower your interest rate, the per diem daily interest cost is, of course, going to be less on the refinance. But you'll have to pay interest for whatever days remain in the month. That would get added in here as well. We add up the closing costs at a net of $1,726. We have the escrow deposit at $7,400. We know that the loan payoff is $500. The total due at closing, therefore, closing costs, escrow deposit, plus the payoff, we're at $509,126. We subtract the new loan amount on the refinance to determine the total amount that's going to be due at closing. And again, like I did before, if you move that loan amount up or down, that's going to change that bottom line amount due. So I hope this brief primer is going to help you as you're kicking around refinance options. I'd be more than happy to take a look at your scenario myself. I can offer you certainly great conversation at very competitive terms. Feel free to call me, text me anytime at the number in the description below. Thank you so much for watching.